Starting our last session today that should focus on the emerging architecture of finance and trade, managing risk while promoting growth. This has been the sort of, broadly speaking, the topic of our work at the Institute in the past 12 months. We have looked more particularly at what's happening in Europe in terms of growth or lack of growth, what is happening in the US, and the narrative that has emerged after 12 months of observing that is that of what some call a great divergence, the possible decoupling of a growth path, US finally reaching what economists would call the escape velocity, sort of self-sustaining growth, and Europe still lagging behind. And the question basically that we're trying to address in this panel is, on one hand, does this mean that the US will be so strong and strong enough to pull Europe, and I'll be a bit blunt here, out of its misery, or will we see actually the opposite? Will the potential stagnation in Europe, or even the possibility of Europe plunging into a renewed recession, have some sort of gravitational pull on the US and also weaken the American growth in the months to come? And coupled with that, and this is sort of the big macro question, coupled with that, there's also ongoing changes in the financial sector. One of the sectors that clearly needs to function properly in order to allow liquidity to flow, credit to flow, not only to big companies but also to smaller companies and to consumers ultimately. And there have been some significant changes in the past years, and in the past year in particular, and in particular in Europe in this case, because the European Central Bank has assumed a new role. It's now also the single supervisor for European banks, and precedent to that, European banks have undergone a comprehensive assessment of their balance sheets, basically comprising of an AQR, of an asset quality review, looking at the books, looking at the balance sheets of individual banks, the biggest, more important banks in Europe, and then also having with the EBA, with the European Banking Authority, a stress test that clearly was much more stringent than previous ones, or the previous one that the EBA had done in 2011. And so there is, on one hand, there are changes in the financial architecture, particularly in Europe, but not only in Europe, and new capital requirements for banks that are not only European are clearly having an impact, or could have an impact. And on the other hand, we have this macro environment, which is, to say the least, tricky. And we've seen in the past weeks that volatility is making a comeback. We've seen in October that markets plunged quite dramatically. There was a sort of liquidity problems and what some have described as a flash crash. We've seen in the past days, in the past week in particular, that things are very choppy due to probably two factors, and we'll see, what the panelists think about it. On the one hand, the fact that investors are waiting for guidance from central banks once again. And in this case, they're waiting for some stronger signals from the ECB, possibly launching outright purchases of assets, what is commonly known as quantitative easing. And this hasn't happened yet. And on the other hand, we've seen a sharp drop in oil prices, which is clearly rocking the boat to some degree. And so in order to talk about all this, which is quite a lot, we've invited a stellar panel. Most of the panelists here are very good friends of mine, as well as being very, very competent experts in this field. To my left, Seth Carpenter. He's Assistant Secretary of the Treasury. He spent a long time at the Fed in Washington. You have the biography, so I'm just going to briefly go along the desk here. Holger Schmieding, who is the chief economist at Berenberg Bank. He is based in London. He looks at what is happening in Europe very closely, and I follow his analysis very closely and find myself very often in agreement with what he has to say. Andreas Nick, a member of the German Bundestag, CDU, the party of Angela Merkel, a man that is very closely associated with the Institute and with myself. He used to be a trustee of AICGS before he took over his new position. We still talk a lot about what's happening in Europe, both on the political side but also on the economic side. Robin Brooks,
former investment banker.
Yes, I should say that too. Former investment banker. Then we have Robin Brooks, managing director at Goldman Sachs. He is a global currency strategist. He also has a past at the IMF. Also a very good friend of mine. We often talk about what's happening in the world, but particularly in Europe, and ask ourselves the question of monetary policy and how monetary policy could evolve in the coming months in the Eurozone. And finally, Pat Parkinson from Promontory Group based in Washington. He is also somebody that Seth knows very well because they happened to work together at the Fed, where he has a distinguished career of, I would say, multiple decades. I don't going to go into how many they are. He was, when he left the Fed, head of a banking regulation at the Fed. He left in 2011. You can imagine how choppy, how interesting, but also stressful his time at the Fed in the last years was. I don't know how stressful it is now. We'll maybe find out in the course of the discussion. So without further ado, Seth, you paint the picture of the great divergence, if there is a great divergence, and what lessons the US is drawing from the past years, and whether there are any lessons for us in Europe looking at the US. Thank you.
Thank you, Alex. One of the earlier panels, there was a discussion of foreign policy, and there was a strategy that was, if there's a problem that's not solvable, you should make it bigger. I'm an economist, so when we have problems that aren't solvable, we make them smaller, but slightly differently. If you lose your keys, look under the light post, because that's where you can see. So instead of the big topic of emerging architecture and finance and trade, that's too big for me to be able to think about. I'm just going to try to talk a bit about the notion of the macro divergence that is very much in the news, and some of the questions that arise in my mind when I think about it. People often look at financial markets to try to understand what's going on in the economy, on the assumption that financial markets distill all the relevant information and give you a clear signal. What, of course, is ironic is lots of people here on the panel who've worked at investment banks or currently work at banks know that financial market participants are all frantically trying to look at the economy to figure out what's going on, and so it's a two-way dialogue between the economy and the financial markets. So divergence, macro divergence. Looking at the United States to start, I think the news is generally good. The first quarter of this year was clearly a bit of an anomaly. There was negative growth, some of which can be explained away, some of which cannot. But since then, we've seen jobs consistently being created in the hundreds of thousands each month, and most recently in November, 321,000 new jobs. The unemployment rate has fallen dramatically. It had peaked during the recession around 10%, fell to 5.8%. There now are some signs of growth in wages, so another good sign. Inflation, on the other hand, is a question, and that's going to be a big question that we're going to come back to when I start talking about some of the puzzles that I see in the divergence story. So that's the U.S., and you could probably lump the U.K. in there, but this is supposed to be about the United States and Germany, so I'll talk about the U.S. on the one hand and Europe more generally on the other hand, of which Germany is, I would say, the strongest single economy right now, but the outlook there is substantially less clear. Growth has been much lower than it has been in the United States. Inflation is low and potentially falling further. Whereas now most of the story in macroeconomics and in financial markets is about the outlook for the Federal Reserve and if and when it might start raising interest rates, the opposite is true. So let me just there with the first brief mention of monetary policy. I used to work at the Fed. I don't any longer. I work at the Treasury. So I'm going to try to steer as far away from actually talking about monetary policy as I can. It's just considered bad form for the Treasury to talk about it. And then more generally, everything I'm going to say from now on is just my views, not the Treasury's. So strong growth in the United States, job growth, falling unemployment, strong GDP numbers over the past couple of quarters, almost the opposite then in Europe. And so the divergence story is unremarkable that people should start to be telling it. And if anything, looking at what financial market commentators are saying about interest rates in the United States, some of the questions is why things aren't in fact diverging more quickly. There are a couple of curveballs that are thrown into the mix that I think are worth mentioning just to set the stage. You cannot talk about macroeconomics over the past couple of months without mentioning oil. Oil prices have fallen dramatically, depending on which measure you're looking at. WTI, West Texas Intermediate, just fell below $60 a barrel. Brent is down close to $60 compared to well over $100 going back about a year. And the importance there is not so much just the price of oil, but the effect that oil prices might have on inflation going forward. There's inflation again, and on potentially growth to the economy. So one quick question that's going to be important in thinking about whether divergence is the right theme, how big of a theme it is, how strong it is, how much we should expect, and how soon is this inflation story, is the right approach from an economist's perspective to look through the low inflation, the falling in oil prices, and what it does to the inflation rate, or is the falling in inflation because of oil prices and other circumstances an important part of the story? So then going back to financial markets, where are we? A lot of economists would summarize financial markets, the state of financial markets as it relates to the economy by looking at interest rates. So today, depending on what point of the day, 10-year Treasury rates are at about 2.10%. That's a very, very low number by historical standards, and not necessarily a number that you would expect if you thought you were in the midst of a fairly rapid expansion in the U.S. economy and at a time when people are anticipating a quote-unquote normalization of policy coming. But then look at European yields, and you see that Italian and Spanish yields in particular are below Treasury rates. As the official who works on the selling of U.S. Treasury debt, I try not to take that personally, that people are willing to pay more for Spanish and Italian debt than Treasury debt. But I think that is one of the big issues that we can't escape. And moreover, German yields, 10-year boons, are around 60, 65 basis points, so even lower. So therein lies part of the idea of the divergence, and what could this be telling us about the economies going forward? So here's my divergence into technical economics world. Economists often talk about the so-called expectations hypothesis of interest rates, and all that is to say that if you look at longer-term interest rates like 10-year yields, that should reflect two things. One is how you think short-term rates, say the rates that central banks set, how that's going to evolve over the next 10 years, plus this special magical thing that we call the term premium, which reflects all the other reasons why an investor might want to buy that longer-term debt. So on the face of it, especially looking at that first part, you might think that short-term interest rates in Europe are going to be low for much, much, much longer than they would be in the United States, and that seems plausible. Given the characterization of the two central banks that Alex started off with. But it seems hard to believe that could tell the whole story, and this is where we get back to the notion of this term premium. What else is driving investors to buy U.S. Treasury securities versus sovereign debt in Europe? And here, one wants to keep in mind that if you're a global investor, these fixed income markets are global markets. In fact, each of us could go home if we wanted to log onto our computers and buy any of these securities. Why, you might ask, would you buy a 10-year Spanish piece of debt at a yield that is lower than what you get from the United States. And so if one starts to reflect on that, you could imagine that there are investors who would want to shift from peripheral European debt that pays a rate that's below U.S. Treasury debt into U.S. Treasury debt, in which case you might expect more demand for U.S. Treasury debts, which would tend to push the yields lower, and less demand for peripheral debt, which would tend to push their yields higher. And so then we're left in a little bit of a puzzle. Should U.S. yields be pulling Eurozone rates higher, or is it the case that Eurozone rates are pulling U.S. Treasury yields lower? On one level, that's a difference without a distinction. But as we get further and further into the macroeconomic recovery, especially here in the United States, that distinction is actually going to matter as policy normalizes and as domestic U.S. interest rates start to rise. I think the question then becomes, will that be more of a pull from the United States interest rates to Eurozone rates, or is it going to be a pull down of Eurozone rates on U.S. rates? This is going to matter a great deal, I think, for how financial markets evolve. If we take a quick step back in economic history to the early 2000s, at that point, as the economy was starting the first decade of the century, I never quite know what to call that decade. As the U.S. economy was recovering, short-term interest rates began to rise, but in fact, longer-term interest rates didn't rise hardly at all, and this is what Alan Greenspan called a conundrum, that short-term interest rates were rising much more, and longer-term interest rates were not rising at all. Could that happen now? Is that some of what we're seeing? Well, I would just cast everyone back to the first Friday of this month, which was the 5th, when we got the data on what the labor market did in November. Then we got a very, very strong reading that the U.S. economy added 321,000 new jobs. And in fact, on that day, short-term interest rates rose, notably, 10, 12 basis points up to 2 or 3 years, whereas longer-term interest rates rose, but only by a small amount. So this is what economists call a curve flattening. And again, it seems to be setting the stage, potentially, for that same type of pattern we saw during the conundrum, but also it could be indicative of this tension between Eurozone yields pulling U.S. Treasury yields down. But at some point, as overall economic growth in the United States improves, and presumably as interest rates rise in response to that, you would see some additional upward pressure by policy in the United States for interest rates. And so then this tension, who's doing the pulling? Is it Eurozone rates pulling treasuries down, or is it treasuries pulling Eurozone rates up? That distinction is going to matter a great deal more. I talked a great deal about inflation. So right now, I don't think anyone is worrying a great deal about inflation to the upside. And it would have been the case 20 years ago, maybe even 10 years ago, if you had a conversation of American financial market participants, macroeconomists, and German financial market participants and central bankers, you would have worried about inflation to the upside. The Bundesbank is notoriously proud of its anti-inflationary stance. Now, the concern is about inflation being too low and perhaps falling negative. Why does that matter? And this is the last thought that I want to try to leave on. That notion that I talked about before, the term premium, that whole set of other reasons why investors might want to buy a 10-year treasury note, for example. If inflation is low, and if inflation were actually to fall very, very low, then the yield that you're getting on that fixed income security, that treasury debt, is going to be worth more in a lower inflation environment than in a higher inflation environment. And so if you're an investor and you're trying to figure out how much to pay for this security, one thing you might look at is what's going on with inflation, and is there a good chance that inflation is going to be low and perhaps fall even further at some point over the next 10 years? If that's the case, then this 10-year debt is going to be worth a great deal more in those occasions. So I might be willing to pay just a little bit more than I otherwise would for that kind of insurance against low inflation. That is what economists would call contributing to pushing down, to narrowing that term premium. That means that the investors would be willing to pay more in a low inflation environment for a longer term security. So why is this relevant? In the United States, macroeconomists talk about the so-called Great Moderation. From 1985 until present, the macroeconomy has been much more stable than it had been over previous decades. Inflation is low, and it's been falling, in fact, over those 30 years. Presumably, then, what had been the scenarios, the pricing models that economists used before the Great Moderation are no longer valid because inflation is lower now than it was before and likely to stay low for a long time. Think about it this way. In those 30 years, 1/5 of that time, the past 6 years, short-term interest rates in the United States have been at zero. 20% of the time, interest rates are at zero. If that's a concern, low inflation, persistently low interest rates, if that's a concern for the United States, presumably that's even more of a concern for the euro area, given what we're seeing now in the economy. And so these notions of how low are interest rates, how low should interest rates be, and what is it telling us about the economy? I think anything that you learned in textbooks leading up to the financial crisis and past has to now be taken with a great grain of salt, because I think the signal that we're getting from interest rates is much more nuanced and much more complicated because of lower inflation, lower persistent growth, and a greater probability of being at the zero lower bound for a longer period of time.
Thank you, Seth. Thank you very much. Holger, so, we've talked about interest rates, about inflation, about how those two are linked. And clearly the signal that we're receiving from Europe is that a lot of investors seem to price in an even further fall in inflation, if not an outright deflationary environment. What's your take? What's your outlook if you're trying to look a few months ahead into 2015?
Well, yes, inflation is likely to fall further. We will very likely print negative numbers in the Eurozone very shortly. Some people will call that deflation, but I will say that to that only thank you. Cheap oil is good for all of us. And a little side comment, if I may, on the observation that Italian and Spanish yields are below Treasury yields. Yes, of course, makes perfect sense. First of all, if you look at the last 15 years, the rise in the public debt to GDP ratio in the US has been almost twice as much as that in the Eurozone. And if you look at the fiscal challenges ahead, according to IMF calculations, the fiscal challenges ahead for the US, which is largely entitlement reform, are almost twice as pronounced as the fiscal challenges ahead for Italy and Spain. So apart from discussing inflation and the growth outlook, just on that account, low yields in the Eurozone make some sense. Over the last 2 quarters, where in the Eurozone have we seen serious economic growth? First, Ireland, followed by Greece, followed by Spain, then a few tiny Baltic countries, then comes Portugal. Where do we have the strongest employment growth in the Eurozone over the last 4 quarters? Portugal, 1.9% rise in employment year over year, followed by Greece, 1.6%, Spain, 1.5%, Portugal, 1.4%. Well ahead of Germany, actually. What do these 4 countries have in common? First of all, thank you, Dr. Nick.
Program countries.
Exactly. You probably voted in the German Bundestag to support these countries. Thanks again. The program countries economically are on the way up. The tough medicine of austerity and reforms is working. Just as it worked in the United Kingdom when I was a student there in the early 80s, just as it worked in the Scandinavian countries in the early 1990s, and just as it worked in Germany 10 years ago when Germany turned itself from the sick man of Europe into now one of the structurally stronger economies of the continent. In Europe, you need structural reforms, labor market reforms, much more than anything such as fiscal stimuli or monetary stimuli if you want to put your economy on a sound footing. In the US, where there are loads of problems, but not a lack of labor market flexibility. In the US, this particular European thing, that the key for Europe is not the interest rate, it is labor market flexibility, is often not understood. And that, in my view, explains at least half of the transatlantic divergence in the economic dialogue, which is often a dialogue of the deaf between some academics in Europe and some academics in the US. It's just what you're used to. If you take labor market flexibility for granted, you miss what's wrong in Europe, and thus what needs to be fixed in Europe, and what now in a number of countries has been fixed, I would say. What happened this year, though? Germany is a structurally strong economy, but this year Germany is the big economic disappointment of Europe. Germany fell from 2% growth up to the month of April into stagnation ever after, suddenly. There is no explanation for that except the Putin shock. That is the shock of an atomic power invading a neighboring country, which, if you're in Berlin, doesn't feel like being so far away. So it has been German business investment that has fallen ever since Putin invaded Ukraine. German exports are still rising. German private consumption, contrary to rumors, is actually rising nicely. It's been German business investment, the big disappointment this year in the Eurozone. And the single biggest reason why the overall Eurozone, unlike the US, has had mediocre growth over the last couple of quarters, rather than the modest acceleration of growth that I had expected at the beginning of the year. What is the outlook now for Germany and the Eurozone, cyclically? First of all, the big bet is what happens to Putin. I think there is some justice in what oil prices and the Russian market are doing now. Less than 9 months after invading Crimea, he is getting punished like I couldn't have dreamt it up better. It is really harsh. And if he actually believes that falling oil prices are a Western conspiracy, all the better. That may teach quite a few people a lesson, although it's probably not fully true. So my outlook is that a weakened Russia will not create again mischief of the kind which it has done this year. And as a result, with geopolitical risks hopefully fading a bit, German business investment will rebound next year, and that in itself will almost double the growth rate of the entire Eurozone. Why? Well, if Germany goes from 0 to 2% again, rather than vice versa, that makes a difference. And that actually helps the neighbors, including France and Italy, and very much Austria, quite a bit. Secondly, I expect the periphery to continue its recovery. We have to watch some political risks very much, including Greece, but economically the periphery is doing fine. And thirdly, we will get a bit of a boost from the exchange rate, that's not much. A bit of a boost from monetary policy, that's not much. And a boost from oil, which is huge. Current oil prices are worth a rise in GDP in the US, Japan, the Eurozone, after a year of a good 1 percentage point. If you ever wanted to have a fiscal stimulus, that is it, especially as it's paid for by Venezuela, Russia, Saudi Arabia, and not by our own taxpayers. So I do expect the economies, led by Germany coming back to growth, the economies in the Eurozone to recover. But of course, I have to admit there is one big risk. I've already mentioned that a lot of times. What does the wounded bear Putin do if, instead of becoming a bit more peaceful, he actually decides to lash out once again to bolster his popularity? We would have a bit of a geopolitical problem next year. Unfortunately, life is never short of risks. Thank you.
Thank you, Holger. Thank you very much. Before we go to Andreas and Pat, I wanted to ask Robin to give us his take on all of this, particularly in view of the fact that there are some implications. You know, you touched upon currency, exchange rates, and you also briefly touched upon monetary policies. And I think Robin has something to say and to show us about that.
Awesome. Okay, thanks. Thanks for having me on this panel. Seth, I'm guessing, is American. Holger, I'm guessing, is German. I'm going to bridge that divide on account of being half American, half German. So one route to go for someone like me would obviously to provide a perfect harmony between the two views. I'm going to go a different route and basically attack both. You know, I'm just a currency strategist. I look at the markets, and I think the divergence that Seth talked about feeds directly into what I'm going to talk about. And you know, some of the things that Holger said about the structural issues and the rebound in Europe feeds into it as well. I gave a presentation here thanks to the organizers exactly a year ago, and so the starting point of that presentation was to grade European policymakers on their progress in dealing with the European crisis. And so I'm a keen observer of my kids in school, and they get smiley faces no matter what they do. So I thought at the time that is also the way to go in a forum as serious as this one. And so, the European crisis obviously has many different facets. There's the sovereign crisis, so this is what we know as the debt crisis, and I think ECB President Draghi in particular, with his speech in 2012, gets a big smiley face for dealing with that, and I gave him this smiley face a year ago, and I'm not going to take it back today. So he keeps it. Now, the second, if we could go forward one slide. So the second slide is the next smiley face is for the banking crisis, and as you can tell, I'm giving like a half a smiley face. Like a 5 out of 10. And I think the story there is obviously very complex. We've had the Teltro operations. The take-up there has been disappointing. I think the underlying situation is still murky. And then the final crisis, which I think is the biggest crisis, is the growth crisis. And obviously, these things are all interconnected, right? The sovereign crisis feeds into the banking crisis, given that banks hold a lot of sovereign securities, and the fact that the lending channel is clogged means that growth is behaving differently from what we might consider a normal template of a crisis. But I think what I find, given all the noise in the markets that I am bombarded with day in, day out, I find what is very helpful is to keep this last point, the growth crisis, in mind, and to understand that what Europe fundamentally is suffering from is an environment where growth is very difficult. Now, I'm going to come back to something that Holger said on employment growth in the periphery in a second. So maybe we can go to the next slide. So, in my opinion, what's going on in Europe can be summarized in this slide, and it's really very simple. So I'm going to stand up just to explain this. And I actually showed these slides last year, and so this morning I went to my office and I updated this slide. This chart here shows you the real exchange rate in black, the black line for the Europe, what we call the European periphery. So Greece, Ireland, Spain, Portugal, Italy. And then time T here is May 2010, so that's when these countries started running into serious trouble, and that was, of course, the time of the first Greek bailout, so May 2010. And the black line is the real exchange rate. It is, in other words, the nominal exchange rate against your trading partners, adjusting for differences in price levels. So it's basically just a measure of the competitiveness of the European periphery. And the blue line is what you get if you lump together all the emerging market crises that we have seen. And, the common pushback that I get to the slide is, well, emerging markets are very different from what's going on in the European periphery. And of course, that's true in many respects. But the European periphery crisis at its root is a current account financing crisis. You had large current account deficits on the periphery. There was a big shock, the global financial crisis. All of a sudden, the capital flows that underwrote those current accounts collapsed. There was a sudden, what econ geeks like myself call a sudden stop, and so you have what is essentially a balance of payments crisis, which emerging markets have seen again and again and again. And so when I made this chart last time I was here, imagine it's cut off here. What happens in emerging markets across the many episodes of crisis that we've seen is that you go from an exchange rate at the time of crisis that is indexed to 100 to an effective real exchange rate of 70, so a 30% deval in no time. This chart is in months. And the interesting thing is that deval is more or less permanent, right? So you get a huge boost to your export sector, which of course helps you claw your way out of crisis, right? That is the mechanism in emerging markets for dealing with crisis. And Europe is trying a different model to that, which is called internal evaluation, where because we have the euro, and because exchange rates are basically locked in, you're trying to do structural reforms, the kinds of things that Holger was mentioning, and that's supposed to push down the domestic price level. And so the amazing thing is that, you're really nowhere. You really haven't done any internal evaluation. In fact, the last data point in the black line is October 2014, and we're all talking about the euro going down because we watch euro dollar, in my case, obsessively. But in fact, when you take into account the fact that the yen is weakening like crazy, that many emerging markets to which key German exporters have exposure, so it's an important trade weight for the euro, and for the euro periphery, which exports into Germany. In trade-weighted terms, the euro has not fallen for these periphery countries. It remains super expensive. Okay, and so if you think about growth in these places and this growth crisis, where is the growth supposed to come from? I mean, ordinarily you have this large external positive impulse in emerging markets when the exchange rate collapses, and in Europe you don't have that. You have structural reforms. Okay, so where have those structural reforms left us? So the right chart is very similar, but it's for real GDP. So it shows, again, in event time, where T is the moment, in the case of the European periphery of the Greek bailout, it shows in black the average GDP-weighted real GDP level in the periphery, and then obviously it's got the emerging market profile as well. And I think the chart just tells the story. Okay, it's not complicated. If you constrain an important mechanism of adjustment, then the adjustment is going to take super long, and it's going to be super painful. And so I think that's what is happening in Europe. And so, for example, when Holger says employment growth in Greece and so forth is positive, you got to factor in that employment levels are way low. Right? So I think at that, given that growth is positive, it's hardly a miracle. At some point, stuff is going to bottom, and I think obviously mathematically from that point on, you're going to register either zero growth in employment or slightly positive. But that's not the burden of proof that we should be measuring ourselves by for Europe. The burden of proof should be what happens in the counterfactual, which is, a big rebound. And politically, we all know that for Europe that's important. If we could go to the next slide, please. All right, so there's a growth crisis. We're all talking about inflation. I'm guilty of that as well. And Seth talked a lot about the role of low inflation, the implications for the term premium. I think at the end of the day, I think the focus on oil prices is helpful. And I think for Europe in particular, the decline in oil prices is obviously comes at a vulnerable time, given the low inflation levels. But I think the real story is a much deeper one. And so, the story is one of weak domestic demand on the back of this growth picture. And so that's really, I think, what's going on with inflation. So this left chart is how we try and look at inflation. So the question is, what part of low inflation is due to temporary supply-side shocks, through which maybe we should look through? No one knows, right? Or is there a more fundamental issue at hand? And so what we do at Goldman is we weight up the CPIs according to their persistence. So, if you imagine haircuts, which in my case I have no experience of, but haircuts, those don't change very much because the guy doing the haircut, is competing with lots of other people, and that kind of price ends up being pretty sticky. So in our CPI baskets across the advanced countries, we weight up that component. I actually have no idea if it happens to be exactly haircuts, so that was an example. So along here is when we do that, where does inflation fall out? Versus on the vertical axis, what is actual headline inflation? Okay, so headline inflation tends to be heavily influenced, as all of you know, by oil prices. So obviously there's a supply story there. But this persistence-weighted CPI, because commodity prices bang around, it ends up being mostly the domestic stuff, mostly services and so forth. And so we focus on this because actually it ends up predicting headline inflation better than core. And so what you see is this line is a diagonal line. So if you're on the diagonal, there's really no story of persistence versus headline. But the Eurozone, okay, we're now at 0.3% headline inflation, which is already pretty low. But if you do this persistence weighting, we are in deflation. Okay, so I don't think it's particularly complicated. As Holger said, I think the Eurozone is cruising for inflation on the back of the oil price decline. But the thing that's much more important is that the underlying inflation dynamics are heavily deflationary anyway. Okay. So if we could go to the next slide. So I'm an exchange rate guy, and I see this obviously through the lens of the euro against the dollar. Which ends up being an important exchange rate. It's about 30-40% in the trade-weighted euro in our measure of that. And I think the euro is actually a nice way of getting a sense of where European policy has succeeded and where it has failed. And in particular, I remember very vividly this point here. This is middle of 2012. When Italian yields, Spanish yields were at 7%, the level of anxiety in financial markets was extremely high. For places like Goldman, obviously it was a tough time, and just in terms of understanding what the dynamics are. And obviously here in July, towards the end of July, Draghi gave this very important speech in London, right? I'm going to do whatever it takes to save the euro. And that ended up morphing into the OMT. Subsequently. So was the OMT a good thing or a bad thing? The OMT obviously was, necessity is the mother of all invention. So Europe needed something to prevent the euro from breaking up. So in that sense, the OMT was a success. But more importantly, the OMT was massively deflationary. It was a very deflationary shock. Why? Because the way to think about OMT is it compressed risk premia. Okay, what else compresses risk premia? It's quantitative easing. It's traditional balance sheet expansion from central banks. But in the case of Europe, given the constraints on the ECB, that risk premium compression happened without the accompanying liquidity that goes into the system. Right, the central bank actually didn't print any money. It was all virtual. And so investors took one look at that. And they said, holy cow, this is a huge underwriting of the euro. So if I buy BTPs or Spanish bonos now at 7%, basically the ECB has my back, and I'm going to buy euro, and I'm going to buy those bonds, and I'm not going to currency hedge them. And so it drove the euro up a lot. And so obviously the OMT in hindsight saved the euro, but it was also something that sowed the seeds for subsequent deflation. So if we could go to the final slide, please. All right, so, the growth crisis is really a strong euro crisis, I think. And, if you go back to the previous slide, the crazy thing is that our fair value for the euro is 120. When you have a balance of payments crisis of the kind that I described for the markets, these currencies usually fall 30-40%, sometimes much more relative to their fair value. And the euro is still, at these levels, above its fair value as we calculated. And so you certainly should not think that, given the declines in the euro that we've seen, that the currency is anywhere near cheap. It's expensive. So if we can just go back to the slide, sorry, I'm jumping around. So in other words, the OMT thing, it was helpful, but it had a big flaw, which is that it was massively euro bullish, and so that has to be fixed. And I think the only way to fix it is through sovereign QE. And I think we have a number of good templates for why that may be the case. Japan is one that comes to mind. Now, I understand that sovereign QE in Europe is complicated because you don't have a fiscal union. And I think European policymakers and ECB policymakers in particular now are trying to navigate that. And I think there are a number of decisions that they can make. For example, is the ECB going to be senior relative to the existing bondholders? Or is the buying of bonds going to be done by national central banks as opposed to the ECB? And I think there is a huge risk of making wrong decisions here for QE in Europe to work as it did elsewhere and to weaken the euro. There should be no seniority. The securities should be bought on the central ECB balance sheet. Otherwise, I think the markets will very quickly punish the ECB and European policymakers for that. So I think my recommendations here are do straightforward QE, capital key-based bond buying from the periphery, from the central bank balance sheet, from the ECB, no seniority, pari passu, etc. Implications for the rest of the world. So I think for the US and others, there's always the fear that quantitative easing and a weaker euro is going to spill over into a current account surplus for the Eurozone, which just goes stratospheric, goes to +6. And I actually strongly disagree with that. If you look at the European current account, the German export machine has a current account surplus which is basically flat over time. It actually hasn't benefited hugely from the gyrations one way or the other in the euro. What has caused the overall current account to move into surplus is the fact that you had this sudden stop on the periphery, and those current account deficits went to flat from large negative deficits. So if I, put that together with ECB policy, if the ECB is successful in easing financial conditions on the periphery, I think the current account for the Eurozone actually might deteriorate just on the back of some of these current account deficits coming back. But I'm sure that Holger will take issue with that. All right.
Thank you, Robert. Thank you very much. Next issue, and Pat adds a new dimension to this discussion. I'd like to ask Andreas. Now you have a half German and a full German on the panel. You've heard the U.S. position. How do you position yourself in all of this? And what is the likely reaction of not only the German government but also the German coalition politicians if and when QE is actually announced by the European Central Bank? Which is, I'm just saying it's not just for an obsession with QE per se, but because, we at the Institute, but also, based on the many talks that we had in the past few months, believe that quantitative easing is coming, and it is probably coming very soon, possibly at the next meeting of the Governing Council in January, and if not in January, at the latest in March. But, that's remains to be seen, but it's just our take on things, and clearly there will be a reaction to that. Andreas.
Alex, thanks first of all. I think overall this panel was much more civilized and much less lonely for me than I had initially anticipated, because as a German politician, if you go into these kind of discussions in the US, you're always a bit worried that you may be recruited for the cause of the bad, ugly German who is the one who is to blame for all the problems. But given my long-standing relationship with the Institute and my friendship with Alex Privitera, I was less worried about this. But I've had similar discussions of that kind last week in Washington. So thanks first of all for that. What I would try to do is give a bit of better understanding on the way that German politics and also the German electorate looks onto some of the issues of the crisis, because I think that is taking up on Bob Zalik's point this morning, I think a very important point in building a common understanding of what we are talking about and why, from different perspectives, you may end up at slightly different policy recommendations. I think, first of all, if you look what is the root causes or the origins of the crisis, I think it is important to remember, and there I'm pretty much in agreement in 2 out of 3 points with Robin. We're talking about a sovereign debt crisis in Europe. We're talking about a crisis of the banking sector. And where I would probably deviate, it's not only a crisis of growth, it is a crisis of competitiveness in a number of peripheral countries of the Eurozone. And that has combined to a very severe crisis of confidence that has impacted consumers, investors, and the international financial markets. How does a German audience look to those issues? I think a lot of that is explainable by a very traditional point of view that takes a much closer interest in what we would call the real economy rather than the purely financial overlay of that. And I have to admit, as I said, I was an investment banker. I always worked on the side of investment banking that is much closer to the real economy. I was a corporate finance M&A banker. To admit that at Wall Street, or in old Wall Street terminology, I always worked not in the casino, but in the restaurant of the casino. So, just to explain why I may not be, why I may be much closer to a real economy view than you might expect from a former investment banker. And the fundamental German experience after 2008 was, I think, that our economy suffered massively. In 2009, we had the biggest reduction in GDP we've ever seen in 2009. But we also had a very strong recovery thereafter. And that was mainly driven by export-led growth and underpinned by the fact that the industrial base of Germany was largely intact, whereas in our understanding, a lot of other European countries have basically eroded their industrial base in the decade beforehand massively. Being the equipment provider to capital investment in the world to the emerging economies from China, India, and elsewhere was the main driver for this speedy recovery. That has created an employment boom that we have never seen before in that kind in Germany. We're at the top of employment levels in our economy, and that in turn has led to substantial increases in tax revenues and social security contributions, which has dramatically helped in fiscal consolidation and to come to the point where last week we were able to vote on a balanced budget for 2015, the first time since 1969. A side effect clearly to mention is that low interest rates, both on the euro effect and the flight to Germany as a safe haven for bond investors, has also helped in bringing our debt, our interest levels down in the federal budget. And our export boom has clearly also been supported by the euro exchange rate, which was much more beneficial than if Germany had been on its own. If you look to Switzerland and the Swiss francs, you can see what might have happened to us if we hadn't been part of the eurozone. So I think that background is, I think, important to understand how a German audience would look towards the right recipes for the solution of the crisis. I'm very grateful to Holger for making the point on the positive impact that we've seen in the program countries. Greece may be a special case for a number of reasons, but if you look to Ireland, to Spain, to Portugal, things have moved on very well. And it's important to understand that the origin of the crisis in each of the countries was pretty different. In Greece is a sovereign debt problem. Spain was mainly a construction boom and banking problem. Ireland was purely a banking problem. So the main critical areas today are not necessarily the program countries under the IMF, ECB, EU Troika program, but the big challenge, I think, is in the big economies of Italy and France, who have carefully avoided to be forced into an IMF-led program, which is maybe part of the problem that we're facing today. And I think that explains a bit of the prevailing German skepticism about some of the recipes that are recommended, in particular from some of the ultra-Keynesian orthodoxy prevailing among US economists, not to talk about the missionary zeal of Paul Krugman. But what is hard to explain or to sell to a German audience is that the cure to a crisis which had at its origin too much liquidity and too much debt is purely to be even more liquidity and even more debt. That, I think, is a bit counterintuitive, and it's hard if that is the sole case that is being made, if there's nothing else surrounding. I've been very supportive of the ECB policies up to now. I will be reluctant as a parliamentarian to comment on future ECB policy. My finance minister is even more reluctant to do so. But whatever may be deemed necessary in a potentially deflationary environment, I would at least express my skepticism, being a former corporate banker, as you talked about, clogged credit channels. And I think a lot of my former colleagues from the banking industry are in agreement on that. To get the credit flow to industrial enterprise in Southern Europe going is not primarily an issue of liquidity. The issue is somewhere else. And if that's not addressed, we can pump as much money into the system as we want. It will not solve the underlying problem of competitiveness in those areas. So where I think we have a broad consensus is, and that was also again stated at the G20 meeting in Brisbane, that we need to achieve a sustainable growth going forward. We need the right combination of structural reforms, higher investment levels, and more on the sustainable fiscal policy. And there may be disagreements, let's say, to how these three elements play to each other. But we would clearly take a view that without structural reforms, pure macroeconomic drugs in terms of fiscal or monetary policy may not solve the problem going forward. And I think Japan, for a number of reasons, or what you can observe also at the moment with Abenomics, is a good example of how that does not work over the long term. This having said, I think I would be the first to admit that there is no reason for German complacency. I think we've made some questionable political decisions over the past 12 months, partly because we were forced by an election result into a coalition that left no other room for maneuver. I was not necessarily very much in favor of doing this coalition, but at some point it was the only option left. You may have heard the comment by my chancellor last week that she also regretted that other options faded away because other parties disappeared either out of the parliament or were simply running away from taking responsibility. So that is a more German political issue. So I think there is no reason for complacency. I think there's a lot of what we would definitely have to address, not solely in the context of the Eurozone, but also out of poor self-interest in Germany. And I think a lot of that is centered around the whole area of investment, in particular private investment rather than public investment. If you look at, especially in comparison to the US, the three main challenges that we will have to deal with for the years to come are centered around demographics, around energy costs, and, if I may say that as a member of the Committee on the Digital Agenda, in building the digital economy in Germany. So I think we would have at least three areas that we will have to deal with much more proactively. I hope we will be able to show more initiative in this regard, but I think it would be also extremely helpful if we come to a point where let's say the mutual lecturing within the Eurozone or across Atlantic would make some of these would slow down and would make some of the internal policy discussions on that a bit easier. We could talk a lot also about the EU's Eurozone institutional setup or about the issue of trade, but we may come back to that maybe in a second round of the discussion. So that's for me.
Thank you, Les. And you mentioned briefly your skepticism that by only lubricating the financial system, things would get much better in Europe in the short run. And I'm going to pick up one of the smileys or half smileys that Robin presented on one of his slides, just to ask Pat, how important is the financial sector, and how relevant are the changes that are happening in the financial sector, and particularly, I would probably say, in the banking sector, which is not as crucial in the US as it is in Europe, but clearly plays a pivotal role still, even for the well-functioning of capital markets in this country, and clearly for more traditional forms of credit intermediation in the context of the Eurozone or the European Union as a whole.
Right. Well, obviously, we've had some tremendous changes in banking regulation in the last few years. Completely understandable, given that it was problems in the banking sector that were the spark for the terrible crisis we went through. I do think finance and banking is quite important to the macroeconomy. Interestingly, I think most macro models have a hard time finding those effects and tend to understate their importance. But in some sense, the crisis was a testament to just how important they are. When those credit channels get clogged, very bad things can happen to the economy. I think in general, it's interesting, in some sense, we've had tremendous international coordination of regulatory policy, obviously through the Financial Stability Board and the Basel Committee, with, in some respects, the Basel III agreement being the poster child for the ability to cooperate and move forward in a coordinated manner. But I think there are some fundamental differences in the role of the banking sector in the U.S. and in Europe in particular. And also, I think despite all the coordination, there are some signs that trust among regulators is lacking, and I think that's of some concern as well. There is a question, I think bankers frequently warn that tighter regulation could affect credit markets, could affect growth. Indeed, there's a somewhat infamous study that a trade association produced back when Basel III was first being considered that predicted it would be an economic disaster. That's been something of embarrassment because obviously most of the banks have already met the Basel III requirements and the economy has not collapsed. But I don't think that invalidates the point that you could take these things too far and that increasing cost to the banking sector could be passed on through cost of credit and ultimately affect the real economy. I think that's one case where, interestingly, I'm less worried about that in the U.S. than I would be in Europe. And why do I say that? Because in the U.S. we have such a robust non-bank financial sector. Now, it's often sort of villainized as the shadow banking sector, but it has some very positive elements to it. And in particular, if we get banking regulation wrong, the ability of banks may be bad for bank shareholders, but the ability of banks in the U.S. to pass on those costs to their customers and therefore to affect the cost of credit in the economy and economic growth is limited to certain sectors, basically those that are bank dependent. And so many sectors in the United States are not bank dependent. If you ask, for example, what's the chances that higher funding costs at banks can be passed on to corporate borrowers who have access to the bond market, the answer is there's very little chance of that happening at all. So that in some sense, bank regulatory errors are less likely to be troubling in the U.S. Than in Europe. Now, the Basel Committee and the FSB did a bunch of studies back in the 2010 that suggested that they could really raise capital requirements and other regulatory costs quite substantially without having an adverse economic impact. But again, my concern is that the financial sectors of macro models are so poorly developed that why would anyone put a lot of faith in those results? Maybe one last thing I'd like to address before we move on. I am worried about this lack of trust among regulators and the potential this has for balkanization or regionalization of banking systems internationally. I think regulators are right that one thing that they learned from the crisis is that while banks are global during life, they are local in death. And as a result, the location of assets and liabilities at death is pretty important to the various host jurisdictions. In acting on that, since the crisis, regulators have introduced various forms of ex-ante ring fencing of assets and liabilities. The U.S. requirement that large foreign banks form intermediate holding companies to hold their U.S. financial subsidiaries is, I think, the most striking example of that, but it's far from the only one. In fact, one of the striking things about the proposal announced in Brisbane to end too big to fail by introducing these so-called total loss absorbency requirements, which I think is quite important and critical and an important step forward, was the fact that they felt obliged to introduce requirements that loss absorbing capacity be prepositioned in various local jurisdictions to give comfort to the host authority. I think that just speaks to the fact that post-crisis there is a lack of trust. In the U.S. here, the reason that we didn't have an intermediate holding company requirement, and we relied very heavily on on the effectiveness of the home country regulation to address our concerns about foreign banks' operations in the United States was our confidence to that point that the home countries would make available capital to support losses in the U.S. operations if that's necessary. Various things that happened during the crisis called that into question, and I think that's why you have that move. The danger here is that this ends up fragmenting again the global banking system, and I think we have some evidence of that. It's still uncertain how far that's going to proceed, but I think it's definitely something worth worrying about. And then indeed here in the U.S., and I think Alexander alluded to this, in our, again, as I mentioned earlier, our bond markets, our capital markets are so important to the U.S. economy. And when you look at the structure of capital markets and markets for risk management projects here in the United States, the sort of scary thing is that there are really only 5 U.S. banking organizations that compete in those markets. The good thing is that because we have so many, half a dozen to a dozen foreign banks that are major participants in those markets, they're not terribly concentrated, and therefore I don't think terribly fragile for that reason. Our host bank, of course, being one of those. But if these various costs that are now being imposed on cross-border banking led those foreign banks, mainly European banks, to pull back from participating in U.S. capital markets and risk transfer markets, I think the having just 5 banks left would be a very dangerous and unacceptable outcome. So I think that's something to keep an eye on. Will that happen? I don't know for sure. I think only time will tell, and I think people that say this isn't going to matter because we have a macro model that says finance doesn't matter are ignoring the fact that the crisis showed us that finance really does matter. So that's...
Thank you, Ben. Thank you very much. I'll open up to the floor right away. We have a few questions, and then we'll have to close the session. Please. And please introduce yourself.
My name is George Bulow. I'm an entrepreneur. I have many friends in Europe, a large number of them German, who for some time have been complaining to me about something that I personally am experiencing now myself around the issue of ring fencing. As entrepreneurs, as investors, as people, not as corporations, we are finding increasingly that all of the banks with whom we have been dealing are effectively forcing us back within our own currency zones. And I have to say that when you do this in aggregate, for individuals, it's very small by comparison with what we're talking about in terms of sovereign debt or major holdings of international institutions or even multinational corporations. But in terms of ability to fund entrepreneurship, in terms of trying to find investments overseas and finding an effective and inexpensive way of doing such a thing, it's become increasingly difficult. I'll just cite quickly, I have large currency positions in non-US dollars, and have found it almost impossible to keep those currencies in banks of those countries that will carry them. And I've been forced into a personal situation where I don't know what I'm going to do, but I'm very unhappy about that. And I have seen this compounded many, many, many times over. It's attributed possibly to regulation. Some people cite Frank Dodd. I don't think so. But you're seeing this throughout Europe. I don't know Asia quite as well, but certainly there. And it also means that many, many, many European entrepreneurs will no longer do business with United States banks or United States companies if they have to come through our banking system.
Thank you very much. And Krishna, and then we'll just lump them together and take them.
Thank you, Krishna Guhat. I had a question actually particularly for Dr. Andreas Ney. You touched very briefly in your remarks on the institutional question. You didn't have opportunity to develop it. I just wanted to invite you to comment more on that. It does seem to me that a lot of the difficulties we observe in the Eurozone relate to the fact that we're sort of trapped in a sort of low-value equilibrium of insufficient structural reform, insufficient sort of counter-cyclical fiscal architecture, and sort of minimum necessary rather than maximal monetary policy, at least to date. And there's a high-value equilibrium somewhere which involves much deeper reforms, more fiscal integration, and a more unconstrained central bank. But it seems that they're essentially, what we're seeing here is the absence of the institutional architecture that allows you to get from the low-value equilibrium to the high-value equilibrium. So I wondered if you could talk about that a bit as your perspective as a parliamentarian, what it would take to build a stronger institutional structure and what the prospects for that are in the years ahead.
Thank you. Who would like to take the first question? Pat? Maybe it's...
Yeah, well, it's interesting that you say that. Of course, the banks have been making that argument for some time, but in this environment, it's probably not news to you that their motives are often suspect and are not terribly influential certainly on the Congress or even on regulators. So I think it would be very useful for them to hear that point of view more often. I don't think that's been coming through that clearly from people in the non-financial sector. I mean, we see it in some other areas in terms of derivatives. The Congress doesn't seem terribly concerned about adverse effects of derivatives regulation, except as it might affect derivatives end users. And there they've been quite sympathetic and are in the process of dialing back some of the regulations that the real economy finds harmful. But people like you are the ones that, in fact, could influence these debates.
Andreas?
Well, this is an issue where you could talk a whole evening about, so I'll try to be reasonably brief. I think the institutional setup is suboptimal, to say the least. It was never intended in the origin to be that way. I think you go back to the Maastricht Treaty, and especially the German agenda at the time, it was always the plan to have the monetary union being complemented by a much stronger political union. Germany was probably among those countries that was most willing to go that way further. That willingness has probably also been a bit reduced over the crisis, which is one of the reasons why the ECB became so central in this whole process, because it tended to be the only European institution that was fully capable of acting. As a parliamentarian, I also think the European Parliament has a lot of potential to be a much more productive institution if it were not put into a difficult position by some of the voting results, in particular in France and the UK, where people don't seem to take that election as serious as they should, and sending their bozos there to avoid even less friendly terms. We have had, I think, a fundamental crisis of the European Commission under the Barroso leadership, also no question. I have at least some hope that we see a bit more stringent leadership and agenda setting by the Juncker Commission, the way it's set up. But indeed, the most fundamental question is, and that's where I might be in some disagreement also with my Chancellor, is that the European Council of 28 heads of government is not necessarily the ideal setup to make responsible decisions, especially if they meet in all-night sessions behind closed doors, which is not necessarily my idea of a transparent and democratic decision-making process. But I think for the time being, that's what we have to live with. I don't see anyone, especially not anyone outside Germany, who's willing to move forward to a structure where we would have to cede even more sovereignty to a central authority, which would probably be necessary. And I think that was at least the academic debate for a long time. Would we need this grand bargain of establishing something like a central treasury authority? But that would require, I think, full authority for that authority to limit debt take on by the individual states, something that I do not see working for the immediate future. We've tried to replicate some of that with a fiscal compound, but whether that is a more workable framework than the one we used to have before is future will show. And we also had to fight with the problem that the UK was blocking any attempts to take that into a treaty basis, which was more than a bilateral one between the states. So that is a fundamental conflict that we have to deal with. I have to say, if you allow me that historical remark, that the whole idea that the sovereignty of national parliaments over budgets is primarily to be understood as a budget to run excessive deficits. It's not necessarily in line with the history how that right came in place, because if you go to the mother of all democracies in the United Kingdom, the sovereignty of parliaments over budgets was mainly to limit excessive spending and debt, and not to subscribe to the opposite. But that is more of a historical remark that I want to make as a parliamentarian. I think, as always, I would expect it may take some much more external impulse and crisis to move that institutional framework any further. That is something that we also see on the issue of foreign security policy. I think my finance minister recently made in his splendid ironic style, where maybe 5 or 10 years from now we will award Mr. Putin an award for promoting European unity, because that external crisis may push us closer together. Irony by Germans is not necessarily always well understood, so I won't try any further on that. So, but I fear we will have to. I was more optimistic on that 2 years ago, but with the outcome of the 2014 European election, I'm much more skeptical, and I think we'll have to try to live with what we have for the time being.
Thank you very much. Unfortunately, time is up because we have to conclude the session at 5 o'clock sharp. So I'll thank you, everybody, for sticking around for this concluding panel. And Jack, over to you.